Hello and welcome to another edition of Liberty Nation's Swamponomics videocast. I'm Andrew Moran, Ellen's economics correspondent. Each week I dive into the mores of top economic news stories and fish out compelling narratives, or I retrieve fallacies that have been accepted as conventional wisdom by the swamp creatures for years. This week, the coming ESG investment crash? Sustainable investing has been all the rage over the last few years among both institutional and retail traders. It is estimated that 33% of total U.S. assets under professional management belong in the environmental, social, and governance category. Global ESG investments topped $35 trillion last year, and experts say it could reach $50 trillion by the end of 2025. While the industry has been mostly occupied by institutional investors, data has found that armchair traders invested $51 billion in net new money in ESG funds. This is also the fifth straight yearly record. As President Joe Biden has proposed immense spending on climate change related projects, whether it is renewable fuels or green related technologies, investors have turned ultra bullish on ESG open-ended and exchange traded funds. But will it last in this environment? The industry is going through many different hurdles simultaneously, whether it is worries over greenwashing or industry leaders conceding that it will not likely change the world as many anticipate. That said, a growing number of market analysts and financial experts are pointing to possible bubble formations in the ESG world. These folks are warning that astronomical levels of capital flows to environmental efforts, like clean energy, are not being done with conventional investment discipline, rigor, and diligence. According to some, this can damage financial markets, undermine the long-term low-carbon objectives, and distort the ESG industry. Ostensibly, as the Financial Times recently noted, the new mantra on big funds is that, quote, everything renewable is great and everything fossil fuel related is awful. However, considering the enormous growth in fossil fuel stocks from Exxon to Chevron to Suncor, many of which are not confined to the ESG standards and principles, many investors could be missing out. Moreover, in this type of environment where energy prices are skyrocketing and supplies are scarce, it is more than likely that consumers would abandon their ESG pursuits to save a few bucks, stay warm, and ensure the automobile has enough fuel. Indeed, contrary to what green advocates believe, conventional sources of energy will remain a major component of the international economy, even if the world goes mostly green. The International Energy Agency, or IEA, forecasts that fossil fuels will account for approximately 1/5 of global energy by 2050. Still, these are rosy estimates. Look at coal. Rumors of coal's death were greatly exaggerated because the rock is now in high demand everywhere, including in the green-focused Europe, and prices are trading at record highs everywhere. Who knows what will happen in 2050? E.G. Hirano, the former chairman of the board of governors of Japan's Government Pension Investment Fund, is one of the leading experts finding indicators of a bubble in sustainable investing efforts. He is now warning funds to take another look at how much they invest in ESG assets. Today, global investors are engaged in a butterfly distraction when it comes to sustainable investing. When they are too focused on green, they could potentially see less green in their investment portfolios and accounts. That's it for me this week. Please read my full Swamponomics column where I dive deeper into the latest updates regarding the global supply chain crisis. Thank you.
Who are we? We are Americans that believe in liberty. We are a project of the nonprofit One Generation Away. We are patriots who apply the founding principles to the issues of today.
And they keep moving the goalposts on us.
We are educators and commentators who love America and the Constitution. Who are we? We are Liberty Nation.